Demystifying the stock market, basics and fundamentals. Ever watch the news and wonder why everybody's going crazy over a few green and red arrows? Or do you hear your friends talking about bulls and bears and think they're discussing wildlife? Well, you're not alone, and today we're demystifying the world of stocks for you. Today, we are deep diving into the stock market. What is it? What does it matter? And how can you navigate it? Let's get started. First and foremost, the stock market isn't a physical place. It's a virtual network where publicly traded company shares are bought, sold, and issued. Think of it like an online marketplace, but instead of buying shoes or gadgets, you're buying a piece of a company. So why are people glued to their screens, tracking these shares? Well, it's simple. Investing in stocks is a way for individuals to grow their wealth over time. If the company does well, so do its shareholders. Bulls, bears, IPOs, navigating the stock market can seem like learning a new language. But don't fret, we're here to help. A bull market signifies a period when stock prices rise, while a bear market is when they fall. As for IPO, that's short for initial public offering, which is when a company first sells its stock to the public. Feeling inspired to dive in? Remember, while stocks offer potential rewards, they also come with risks. Always do research and consult with a financial advisor. Part 1. What is the stock market? The stock market refers to the collection of markets and exchanges where activities such as buying, selling, and issuing shares of publicly held companies takes place. These activities are conducted through institutionalized formal exchanges or over-the-counter OTC marketplaces, which operate under a defined set of regulations. Here's a more detailed breakdown. When companies want to raise capital, they issue stocks. Buying a company's stock means purchasing a piece of that company, making the stockholder a partial owner. In the primary market, new stock is issued for the first time in an initial public offering, or IPO. Investors buy the shares directly from the issuing company. The second market is where all subsequent stock buying and selling occur. Investors buy and sell these shares from one another, and the company is not involved in these transactions. These are venues where stock buyers connect with sellers. Examples include the New York Stock Exchange, or NYSE, and the NASDAQ. Stocks traded on these exchanges are well established and have passed certain requirements. Unlike formal exchanges, the OTC market is decentralized. Stocks that trade here, often referred to as pink sheets, don't meet the requirements to be listed on formal exchanges. They might belong to smaller companies and come with higher risks and potential rewards. These are used to measure and report value changes in representative stock groupings. Some of the most popular indices include the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. They give a broad overview of the market's health. These individuals or firms are licensed to buy and sell stocks on exchanges. Investors typically buy stocks through brokers. These terms refer to the direction of the market. Rising prices characterize a bull market, while falling prices characterize a bear market. Part 2. Types of stocks and markets. Let's delve into the different types of stocks and stock markets. Most stocks traded are common stocks. It represents a claim on company earnings and assets. Shareholders have voting rights in company matters, typically one vote per share. However, if the company goes bankrupt, common stockholders are the last to receive any remaining funds after debtors, bondholders, and preferred stockholders. Preferred stockholders have a higher claim on company assets and earnings than common stockholders. They receive dividends before common stockholders and have a fixed dividend rate. They typically do not have voting rights. In case of liquidation, preferred stockholders get priority over common stockholders, but still come after bondholders. They belong to companies that are expected to grow at an above-average rate compared to other stocks in the market. They typically do not pay dividends, as companies prefer to reinvest their earnings. These are shares in companies that are considered undervalued compared to their intrinsic value. They often come with lower price to earnings, or P/E ratios, and may pay dividends. Investors buy them, expecting the market will eventually recognize their true value. Belong to well-established companies that return a part of their profits to shareholders through dividends. Popular with income-focused investors, classified based on company's total market capitalization, or market cap equals stock price times number of outstanding shares. Companies with a market cap of under $2 billion, approximate figures can vary by definition. Companies with a market cap between $2 billion and $10 billion, and companies with a market cap over $10 billion. Types of stock markets. Number 1. primary market, where new securities are issued to the public via an initial public offering or IPO. It helps companies raise capital. Number 2, secondary market, where investors buy and sell previously issued securities from one another. Most of the stock trading we hear about takes place in the secondary market. Number 3, over-the-counter or OTC market, a decentralized market where stocks, commodities, or currencies are traded directly between two parties without a broker. Stocks that aren't listed on major exchanges are traded here. Number 4, bull market, characterized by optimism, investor confidence, and expectations that strong results will continue. Generally, when the stock market rises 20% or more from recent lows. Number 5, bear market, opposite of a bull market, characterized by a prolonged period of falling stock prices, generally by 20% or more from recent highs. Number 6, emerging markets, stock markets of developing countries, characterized by faster growth but potentially higher volatility and risks. Understanding the types of stocks and markets can help investors make more informed decisions, matching their investment choices with their risk tolerance, financial goals, and market outlook. Part 3, how to start investing. Starting to invest can initially seem overwhelming, but you can systematically begin your investing journey by breaking it down into steps. Here's a step-by-step guide to help you start your investing. Number 1, determine your financial goals. Are you investing for retirement, to buy a house, or another purpose? Decide on a time horizon. Short-term investments differ from long-term ones in terms of risk and asset choice. Number 2, evaluate your risk tolerance. Understand that all investments come with risks. Determine how much risk you're comfortable taking. Your age, income, financial responsibilities, and personality can all influence your risk tolerance. Number 3, educate yourself. Familiarize yourself with basic investment concepts. Read books and articles or take online courses to understand the stock market, bonds, mutual funds, ETFs, and other investment options. Number 4, start with a budget. Decide how much money you can allocate to investing. Consider beginning with a small, manageable amount and gradually increasing it as you become more comfortable. Number 5, open an investment account. Choose a reputable broker or investment platform. Company fees, account options, and available resources. For retirement-focused investments in the U.S., consider tax-advantaged accounts like a 401k or an IRA. Conclusion: investing is a powerful tool to grow wealth, hedge against inflation, and achieve financial goals. Starting with a clear understanding of one's objectives and risk tolerance is crucial. While there are a myriad of investment avenues from stocks to bonds and more, education is the bedrock of successful investing. By diversifying investments, regularly contributing, and resisting the urge to make impulsive decisions based on short-term market fluctuations, investors can harness the potential of the financial markets. And while taking the initiative to self-educate is commendable, seeking guidance from seasoned professionals can offer invaluable insights. Ultimately, successful investing is a blend of knowledge, patience, and strategy applied consistently over time. We have provided you guys with some basics of the stock market. We have another video covering this topic thoroughly, so we suggest that you wait for that. Till then, keep your knowledge about the stock market up to date.